Hi, welcome back. When I teach my classes on valuation, I start by describing valuation as a craft. Not an art, not a science, but a craft. And the essence of a craft is you learn by doing. And there is no company where I've practiced the valuation craft more than Tesla. It's a company where I've learned more about valuation than I have about the company. Now, along the way, as I've valued Tesla multiple times over the last decade, I've got it hopelessly wrong sometimes. And I'm sure some of you will stop right now and say, why should I listen to this guy get it wrong again? Okay. My first valuation of Tesla was in 2013. At that time, I valued Tesla as a luxury automobile company, as a successful luxury automobile company. In fact, while it had very little revenues, was losing large amounts at that time, I predicted that 10 years out, which would make it 2023, it would have revenues of $65 billion and an operating margin of 12.5%. You're welcome to compare it later on in this session to what the actual numbers came in at. But the value for the equity that I got was less than $10 billion for the company. Part of the reason the equity value was depressed was because I estimated large amounts of reinvestment that Tesla would need to make to get to that revenue of $65 billion. Now, as I value Tesla, each time I've done it, I've learned a little bit more about the company. If I were to summarize the three big lessons I've learned about the company, here are the three lessons. The first is Tesla has reinvented how manufacturing is done in the automobile business. What does that mean? The old-time automobile companies built huge and inflexible assembly lines, capital intensive, and then used them to churn out more and more cars. Tesla has been able to grow with a vastly less reinvestment than the typical automobile company. Second, the Tesla customer base is loyal to a fault. Not only are they loyal in terms of being loyal to the brand, they're evangelists. They seek out friends and try them to buy Teslas as well. In fact, Tesla's biggest sales force is its own customers. And third, Tesla has a CEO that I'm going to describe as unique. And unique not in a bad way. In a world full of CEOs who lack vision, and in fact are walking examples of the Peter Principle. Remember, the Peter Principle is you rise to the level of your incompetence. Elon Musk stands out. He has enough vision to power 100 CEOs, but he is an eccentric and he does things his way. Now, one of the things I've learned about Tesla as I've gone along also is it's a story stock. What does that mean? The value that you attach to Tesla is not just a function of the numbers you see for the company, but the story you tell about where the company is going. In fact, in 2016, I wrote a post on Tesla where I talked about the different stories you could tell about the company. Starting with, what does it do? Is it an automobile company, a technology company, an energy company? Is it focused on the high-end customer base or the mass market? Is it competitive edge that it's a first company out there? Is it the style and the brand? Is it the technology? What is its intensity? Does it invest like a manufacturing company? Does it invest like a technology company? And where does the risk come from? Is the risk that of an automobile company, the risk that of a technology company? Those choices will drive the inputs into your valuation, into growth and margins and reinvestment and risk, and ultimately play out in value. In fact, in that 2016 post, I showed how different stories about Tesla could play out as very different estimates of value. Now, the values themselves right now are not relevant because this was 2016. But the point I was trying to make is when people disagree about what Tesla is worth, they're not disagreeing about a growth rate. They're disagreeing about the fundamental story about the company. That hasn't changed. Now, if you've been a Tesla investor or even an observer of Tesla, along the way, Tesla sometimes does things that make you look and say, what? Why would they do that? I remember in 2017 when Tesla chose to borrow money. You're saying, what's wrong? Companies borrow money all the time. Tesla chose to borrow money in 2017 when it was a money-losing company, and equity markets loved it. They had a choice of using equity. They chose not to do it. Tesla also, if you remember, often sets targets for itself that you look at and say, why would you do that? Now, let me take that back. It's not Tesla that often sets the targets, it's Elon Musk. I remember Elon Musk setting a target that Tesla would meet 5,000 cars a week, completely arbitrary, and then Tesla twisting itself into a pretzel trying to deliver 5,000 cars a week. Sometimes the damage was self-inflicted. When Elon Musk tweeted out, and Twitter has been a classic platform for Tesla getting itself into trouble. Tweeted out that we had $420 funding secured in 2018, a tweet that set in motion a sell down on the stock. In fact, in 2019, stock had dropped to $180 per share. Unfortunately, you can't compare prices now to prices then because you've had multiple stock splits. But at that time, about $32 billion in equity. And I actually bought Tesla for the first time because I found it undervalued. At the time that I bought it, though, I described Tesla as my corporate teenager. And you think, what's a teenager got to do with it? And if you remember your teenage years or your kids were teenagers, remember, it's the job of every teenager to look in the mirror and ask, now I have lots of potential. What can I do today to screw it all up? And what I was trying to say was I was investing in Tesla with open eyes, knowing that this was a company that could make frustrating choices for me as an investor. Now, the 6 months after, though, Tesla surprised me. It did great things. The stock went up fivefold over the next few months. And I sold far too soon, just ahead of COVID. And in fact, during COVID and the months after, Tesla took off. By November of 2021, Tesla was on top of the world, $1 trillion company. And at the time, I revisited again. I regretted, I guess, not holding it still, but that regret was small. I was just curious about what Tesla had done to become $1 trillion company. And at that, in that valuation, I concluded that, that it was plausible for Tesla to be worth $1 trillion, but what it would have to deliver to get to the $1 trillion was mind-boggling. It would have to deliver $600 to $800 billion in revenues and margins of 24 or 28%. In other words, it would have to have revenues like an automobile company, the largest automobile company in the world and beyond, and margins like a very successful technology company. I concluded that post by saying, I love Tesla as a company, but not at $1 trillion market cap. How quickly things can change at Tesla. By the end of 2022, leading into 2023, Tesla was back in trouble. Its market cap had plunged by more than 60%. And people were talking about, when will we hit bottom? So I revisited my Tesla valuation in January 2023. And at that time, I valued the company at about 100. So this, I ran a Monte Carlo simulation. And those of you familiar with my posts, will recognize the simulation where I take an intrinsic valuation and I then allow for the fact that my assumptions could be wrong. And in my January 2023 valuation of Tesla, I concluded that that my median value, my base case valuation would be about $150 per share. Now, about 4 weeks before my valuation of the stock, I'd actually hit $100 per share. But I came in a little too late in this valuation because by the time I valued the company, the stock had already shot through the 150. And I lost my chance, in a sense, to buy Tesla then. But I've been watching it all year. And 2023 has been an unusual year for Tesla. Now, coming out of January, those lows, it had a period where prices went up and up and up. In fact, for the first half of the year, Tesla did really well. It was one of the 7 stocks powering the market. And by the end of June, early July of 2023, the stock was close to $300 per share. That's almost tripling over the course of the year. In the last few weeks, perhaps the last 2 or 3 months, the company's clearly hit some groundswells, and especially in the context of earnings reports coming out across the course of the year. In fact, in this graph, I've superimposed the 4 earnings reports that Tesla has had during the course of the year. The first one in January was the one that triggered the upsurge. April was good. Actually, Tesla came in as expected, but the last 2 earnings reports have been disappointing. And I've listed out what analysts tend to focus on, earnings per share, even though with Tesla, it's not the earnings per share that we should be looking at, but the deeper numbers. But the last earnings report has clearly triggered a wave of selling in the stock, and the stock is, at the time that I valued the stock, had dropped below $200 per share. Now, clearly, there's financial news that's come out about the company that needs to be brought into the picture. So in this graph, I've looked at Tesla's quarterly data going back to 2013, but I want to emphasize just what's happened in the most recent quarters in the table at the bottom. So if you look at the fourth quarter of 2022 and the first 3 quarters of 2023, which are the 4 quarterly numbers that we've seen reported this year, you can see that Tesla's growth has leveled off from the post-COVID surge that you saw, but it's still healthy. In fact, if you break Tesla down into its automobile and services business and the energy business, the automobile business its growth is down. In the third quarter, growth was actually high single digits, but it's growth that most automobile companies would kill to have. Similarly, margins have leveled off in 2023. In fact, the third quarter of 2023 margins were for the automobile sector the gross margins were down, and the overall margin for the company had dropped below 10%. So if you look at the collective evidence for the year, it's that the growth surge seems to have leveled off and profit margins are declining. So that's a financial news that's come out about the company. But with Tesla, it's almost never just about the financial news. There's been news story after news story on the company. And if I were to take the 3 biggest news stories, and this, in my judgment, are the 3 biggest news stories, they all have implications for Tesla's story and valuation. The first was during the course of 2023, Tesla has very aggressively cut prices on its offerings, especially on its lower priced models. And if you look at after the price cuts and even without the credits considered, Teslas are now competitive on a purely price basis with mass automakers in the US. So there have been price cuts. We'll come back and look at the effects of those price cuts. Those price cuts might have contributed to the drop in margins we saw in the numbers. The second, and this is the second big story that's run through the course of the year, has been Tesla's work on FSD, full self-driving. I know that much of this is driven by social media, but it's undeniable that more than any other automobile company, Tesla has put this FSD story out there. And we can debate how far ahead or it is of the competition on FSD. In fact, there's a divide on what Tesla has done in full service driving. Tesla advocates believe that Tesla is way ahead of the competition on full service self-driving. Now, and Tesla's critics argue that it's really just self-promotion, that Tesla is nowhere as far as it claims to be on foot, and that it's dangerous to push this to the forefront. No matter what, though, Tesla is the only automobile company that seems to have made FSD part of its long-term story, that's actually thinking about bringing it into its business model. In fact, Tesla has offered a beta version of FSD to its drivers for $12,000, I think is the latest price. That's a pretty hefty price to pay. But Tesla clearly is thinking about making this part of its revenue model and its business model. So that's the second big story. And we'll talk about how that plays out in the value of Tesla. And third, of course, is the Cybertruck. Now, as many of you know, I'm not a big automobile fan. I own a 2010 Honda Civic. I barely drive. And to me, waiting for a car seems like something I shouldn't be waiting for. But there are clearly people who love their automobiles, and the Cybertruck clearly has got lots of attention. First, because of its novelty, the way it's designed. And second, because it represents Tesla's entree into a market, the truck market, that it's hitherto stayed away from. And that's a market where the legacy automakers still have a very sizable presence. So you've got price cuts, you've got full self-driving and Cybertrucks. And the question is, how does this play out? in the numbers and the value for Tesla. I do think, though, it's time for a reset, that what we've learned about Tesla since the start of 2023 has to be built into value, and the question is how best to do it. Now, so far when I value Tesla in all of my valuations, I value Tesla as a single business company, as primarily an automobile company. So I haven't broken Tesla down into businesses, and I've been taken to task for this. That said, though, it doesn't mean I haven't incorporated the other businesses into my valuations. In my January 2023 valuation, the revenues that I give Tesla include revenues from robotaxis and from software or other businesses. And my margins that I gave for Tesla, 16% margin, are well above automobile margins and reflected the higher margins of these new businesses. So I've buried the other businesses in my inputs. But I do think, given what we've seen in Tesla in 2023, that it's time for me to break these businesses out and deal with them individually. So that's where I'm going to start. I'm going to break Tesla down into businesses and look at each business separately, because each business has very different operating characteristics. Now, before I do that, I want to talk a little bit about how the news stories that have come out during the course of the year will play out in those businesses. I'm going to break Tesla into 4 businesses. The automobile business, and obviously you know what that includes: electric cars, the Cybertruck if it makes it. The second business I'm going to look at is the energy business, which has been there since, especially since 2016, but it's been a small business, but the way it grew in 2023, I think it deserves to be taken seriously as a standalone business. The third business I'm going to look at is software, coming from the fact that Tesla, for better or worse, is pushing full self-driving as software that people can either buy, perhaps a subscription model. And the fourth is robotaxis, and whether the advances that Tesla has made, again, I know there's debate about it, can translate into a large and profitable robotaxi business. Now, I'll take each of the 3 news stories I talked about and talk about how they might affect my storylines. I'm going to start with the easiest one, the Cybertrucks. Now, clearly there's a lot of excitement about Cybertrucks, at least among a subset of the population. In fact, Tesla has a tracker on its website where you can track reservations people have made. Now, take this with a grain of salt, because a lot of people who make reservations don't carry through and actually buy the truck. But I think at last count, when I looked at the tracker, there were almost 2 million people who were interested in buying the Cybertruck. Now, even if only 1/10 of those people actually buy, that's a pretty hefty increase in sales from Cybertrucks alone. Now, just as a note of caution, though, so while the plus is the Cybertruck will be expansion into a segment of the market where Tesla has not had a presence, the truck market, there are downsides in this new product. And Elon Musk, in the most recent earnings call, was actually surprisingly down on the Cybertruck in terms of value. Perhaps it was just the day and the mood that he was in, but he did talk about the potential downside. And I can see at least 2 things that have to be considered in the value-adding potential of the Cybertruck. First is it is entirely possible, we don't know yet, that at the pricing that we're talking about for the Cybertruck, and it's still rumored, 50,000, 45,000 and 55,000, the margins in the Cybertruck will be lower than the margins, at least on the high-end automobiles that Tesla sells. And if this diverts attention away from those higher margin products, Tesla could suffer as a company. The second is, I'm not an expert on this. It looks like the Cybertruck will require its own production facilities. I think the Texas factory is the one that's producing the Cybertrucks, which will require more reinvestment in the future. I'm not saying these negatives outweigh the positives, but they have to be factored in. So here's the bottom line. If Cybertruck sales are brisk and demand is strong, the positives will outweigh the negatives. I'm stating the obvious, but this is a second factor to consider: is who's going to buy these Cybertrucks? Think of a Venn diagram, right? And let's think of three three portions of the diagram. One are truck buyers, the second are people who buy Tesla cars, and the third is Cybertruck sales. If the bulk of Cybertruck sales come from truck buyers, Tesla would gain from the Cybertruck because it's drawing in a new market and it's getting market share away from others. If the bulk of the Cybertruck sales are coming from people who have bought other Tesla models, then it's more product cannibalization. So that's going to be an interesting thing to watch, is who's buying the Cybertrucks. So that's the first news story. The second is FSD, full self-driving. Now, on the plus side, Tesla is clearly further along the road than any other automobile company, not just from a technological standpoint, but also from a business model and a marketing standpoint. I know there are people who argue that maybe Google is further ahead with their Waymo on, but the reality is Google's not a car company. It's not a company that's going to jump into this business. And Tesla seems to be the only automobile company that's taking this as a serious part of the model. Maybe that's a mistake that Tesla is making, but clearly it's out there. Now, I don't think that at $12,000 a piece, Tesla will sell. It'll be a niche market if it's $12,000, but maybe at $2,000 or $3,000, this could be a source of software revenues for Tesla. And if Tesla actually manages to succeed with full self-driving, there's another business that opens up, which is the robotaxi business. I mean, think about your Uber or your Lyft, right? You take an Uber, you pay for your fare. 80% of the fare goes to the driver who owns the car, and 20% goes to Uber or Lyft. Think of an alternate model where you get into a car where there is no driver, right? So already that 80% is yours as the company that owns the car. That's a robotaxi business. The promise of the robotaxi business is without the drivers, ride-sharing becomes a very profitable business. And if Tesla is further ahead than everybody else, maybe they can dominate the robotaxi business. Again, I'm not jumping ahead of myself, so that's on the plus side. On the minus side, there is a very real chance that if Tesla rushes FSD to the market before it's ready, it's going to be catastrophic, because all you need are a couple of high-profile accidents, and you've set back the cause of full self-driving for 5 years, maybe even 10. So we're not quite ready for full self-driving on scale yet. And the question is, when will we be ready, if at all? So that's the second. The third is the price cuts. And this is, I think, the action where I've seen more disagreement among Tesla bulls than any other Tesla action that I've seen in Tesla's history. Now, usually when Tesla takes an action, the Tesla bulls rush to defend it, the Tesla bears rush to attack it. But the price cuts have created a divide even among people who are Tesla true believers. And I think part of the reason is everybody's looking at a piece of the puzzle, and they're looking at different pieces. So what I've done in this graph is actually look generically at how a price cut can affect value. So you're a company with products or services, you cut prices. Your first order effect is always negative, because when you cut prices, you're going to reduce your margins, you're going to reduce profits, earnings, cash flows, and reduce value. So that's the first order effect. But you can't stop there, right? There's a second order effect. Let's look at the possible second order effects. There's a tactical effect, which is when you cut prices, you could increase volume. And if you increase volume enough, you might make up for the price cut with much higher volume, end up with higher revenues and perhaps higher earnings and cash flows. Now, to think about what determines it, the first is the elasticity of demand for your product. If you have a product with elastic demand, then cutting prices will increase value. But it also depends on how competitive the business is. If you cut prices and all your competitors also cut prices, you all end up with lower margins, and none of you ends up getting that volume boost that you wanted. So the value effect of price cuts, and if your objective is tactical, will depend upon whether the units sold increase more than proportionately to your price cuts. And maybe you get some economies of scale where you actually reduce your costs per unit of producing it. So it really depends. Now, if you think about applying this to Tesla, at least over the course of 2023, the price cuts haven't shown up as higher volume. You know, maybe the automobiles are not that elastic, the demand is not that elastic. Maybe it'll take time, but that's a tactical factor. The second is strategic. You cut prices because you want to handicap your competitors. You make it more difficult for your competitors to stay in the business or enter the business. You know, the effect, of a strategic price cut will depend largely on how easy it is for people to enter your business and exit from your business. In businesses where entry and exit is easy, then these strategic actions have much bigger consequences because they deter new competitors from entering and make existing competitors leave. Now, the value effect of a strategic price cut where you're trying to get a higher market share is, in the long term, if a strategic price cut works and your competitors are handicapped, you will end up with a higher market share and higher revenues, potentially higher value. Now, you can play this through with Tesla, and you could argue that the price cuts have had their intended effects on the legacy automakers who already are in trouble in the electric car segments and trying to make money. Maybe this makes it more difficult. And there's a third component, which is when you cut prices for your products, if there are side businesses that you have that benefit from the price cuts, what you make on those side businesses could make up for what you lose in terms of margins in your product. Now, whether this happens in your company will depend on whether you can unbundle your product into side products that you can sell separately, and whether you can make an argument that these side businesses are standalone side businesses. Now, whether this value effect from the side businesses will exceed what you lose from price cuts depends on how big those side businesses are and what the margins and reinvestment you need on those side businesses will be. Now, we talked about software and robotaxis as potential, Tesla side businesses. And you could argue that maybe these price cuts advance Tesla towards an end game where it's not the automobile business that delivers the high margins, these side businesses. In fact, I think Elon Musk has said somewhere along the course of the way that he's willing to, he doesn't have to make money on the cars. It's all the side stuff that he can make money on. Now, you can take that with a grain of salt, but you can see already why the way you look at the price cut would depend on what you think the end game here is. If you think it's tactical, the price cut doesn't look like a great idea. It's not paying off. If you think it's strategic, maybe it's paying off. If you think it's synergistic and the side business of the end game, you're okay with the price cut. So with Tesla, you can see all three potentially play out. So here's what I'm going to start with. I'm going to take each of the four businesses that I said Tesla was in and take a look at the landscape, what those businesses look like. Let's start with the automobile business. In 2022, there were about 70 million automobiles sold. Collective revenues of about $2.5 to $2.75 trillion. About 15% of that came from electric cars. This overall is a low growth business, but electric cars are becoming a larger and larger segment of the business. Now, in terms of profitability, it's not a great business to be in. The median operating margin for an automobile company is 7.36%, and the return on capital is about 9.19%. So it's a very, very middling to potentially even a bad business. Now, Tesla's positioning, it's the 11th largest automobile company in the world right now, based on revenues of $95 billion in the last 12 months. So it's no longer a small company. It has a dominant market share of the electric car business in the US and a significant market share globally, where it does have competition, at least in China, from BYD. So you can see that, Tesla is well positioned and it's much more profitable than the typical automobile company. Even if you take the 2023 numbers where the margins dropped, its margins for the last 12 months, about 11%, well above the industry average, and its returns on capital of 25% are also above the industry average. In terms of potential, I do believe the electric car segment will continue to grow and that Tesla will maintain a dominant portion of that business in the US and a significant portion, perhaps face more competition globally. But as the electric car business grows, Tesla's overall market share of the automobile business will grow. Now, the energy business, at least in the solar energy market, you've got the generation and the storage parts of the business. Tesla, when it bought Solar City, was more in the generation part, less in the storage part. But, but in terms of margin, this is a pretty profitable business overall if you look at pure margins. But the return on invested capital is only 6%, reflecting the capital intensity of the business. Tesla has shifted away from generation to storage over the last few years, and it's paid off. You could see that in the 2023 numbers, where revenue growth in the energy business was strong, the margins had moved up, and the potential for the future for Tesla lies in the storage business. And I think it's well positioned because of the, because it has a technological edge over its competitors. And I think that it will continue to grow its energy business and stay with high margins. Now, if you look at the software and the auto software and the robotaxi businesses, you're at a disadvantage because the existing businesses are either non-existent with robotaxis or very small with auto software. Auto software in 2023 was about $29 billion, but it's expected to grow to $120 billion. It includes the AI software and other components of auto software. It is a business where there are very few standalone companies, but the median software company makes margins of about 22%. Return on capital, the typical software companies, high margins and high return on capital. Tesla right now is a leader in FSD technology, though it doesn't actually have software revenues. And it seems to be the most committed automobile company to making it a revenue source. Now, right now, Tesla, as I said, makes no money, but once established, I expect the margins for its software business, whatever that business looks like, to look like the margins for software companies overall. So I do think the auto software company will continue to grow, that Tesla will have a foothold in the FSD component. And, but I think the overall software market, different segments will be dominated by different players. On the robotaxi business, right now, we have the ride-sharing business. That's all we have. The ride-sharing business had collective revenues of about $106 billion in 2023, and those revenues are expected to grow to about $300 billion in 2033. Now, right now, the ride-sharing business is a mess in terms of profitability. There's no stickiness. The 80% driver share eats away into any possibility of making money. Robotaxis will have a very different economic model without a driver involved, but we don't know what the profitability will look like. Tesla's, again, has no robotaxi revenues right now, but perhaps that lead in FSD, and we talked about this earlier, will allow them to step into the robotaxi business either as a standalone company where they own and run their own robotaxis, or as a partner to a ride-sharing company, where effectively they sell their robotaxis to an Uber or Lyft on the understanding that they keep a share of whatever Uber or Lyft make. Now, so they're trading off lower revenues for less capital intensity. Now, I have no idea what the margins will look like, but if you're a robotaxi company operating as an intermediary, your margins are going to look like intermediary companies. Booking.com, Airbnb, you're basically an intermediary. And those companies in steady state have high margins, 30%, 35%. So I do think there is a potential for a robotaxi company, though there is much we don't know about FSD. So I'm ready to tell my Tesla business stories, and I'm going to break them down by business. I do think that the electric car business, notwithstanding the troubles that it seems to be having right now, will continue to grow as a share of the overall automobile market. Some of this comes from governments helping them out. In the US and globally, there are going to be credits to people who buy electric cars, and that's going to contribute to the growth. I do believe that Tesla will have a significant market share of that market. That market share will come under assault because, existing players will start to get better at electric cars, but Tesla will continue to be a leader in the market. So based on that story, I expect revenues for Tesla from the automobile business to hit $500 billion in 2033, which will make them one of the largest automobile companies in the world at that point in time. Now, in terms of margins, I do think that the auto business will act as an anchor on margins. Margins can't be 20, 25, 30%. But I do think that Tesla will continue to be more profitable than the typical automobile company. I'm going to leave its, the margins in 2023 were about 11%. I'm going to assume that the margins in the long term will drift down, but not by much. So I expect the margins for the automobile component for Tesla to be about 10%. So the reason I expect the premium at Tesla is because I do think that they will get economies of scale in their battery plants and production, which will allow them to have the higher margins. On the energy business, I think Tesla is going to continue to pivot towards storage solutions where it has a technological advantage. And I expect storage to be a bigger and bigger portion of this market. So I expect Tesla's revenues in 2033 from energy to be 80 billion. And I do think the margins will reflect Tesla's technological edge, in the storage business. And I'll give it, pre-tax margins of 16%. Roughly again what they made in 2022 and 2023 put together. In auto software, I do think that there's potential for Tesla to add on FSD as an add-on package to Tesla car owners where they can buy the package. I don't think it'll be $12,000 a piece. I think it'll be cheaper. But I do think the revenues will add up over time at a reasonable price. And I'm going to estimate revenues of $40 billion from the auto software component. And here I'm going to make a guess on the margins. I'm going to assume that if Tesla's software business becomes significant, its margins are going to look like the margins for enterprise software companies, 21.8%. Now in robotaxis, I'm going to make a complete stab in the dark. Now I hear people talking about trillion-dollar robotaxi businesses. I don't see it getting that big. I do think that Tesla will eventually offer a robotaxi solution. I do think it'll bring in significant revenues, but I'm going to cap the revenues at about 80 billion. That'll make it, if it were a ride-sharing company today, the largest ride-sharing company in the world by far. Now, and I'm going to give it the margins of an intermediary company, that the operating margins will be high in that business in steady state. Now, the expected operating margin in 2033 would be about 30%. So when I say expected operating margin, all those 2023 should be 2033s. That was, and I'll fix that in the slides. So I'm ready to bring these all together. So based on this 4 business breakdown of Tesla and adding the revenues together, you see my projected revenues for Tesla increase over time from about 150 billion to almost 735 billion over the next 10 years. In fact, I'm probably overestimating revenues in the early years. Because at least based on my projections, you see the revenues jumping. Part of that is the software business is probably going to take 2 or 3 years. Incidentally, in my story on robotaxis, I forgot to mention that I don't see this business taking off until year 4, 2027, because neither the technology nor the regulatory approval is going to be there till then. So over time, I see revenues climbing, I see margins leveling off, and if that strikes you as as downbeat, it's not. Actually, it reflects the changing mix of businesses. And based on my stories for the 4 businesses, the value that I get per share is about $180 per share. Now, $180 is less than the market price. At the time that I had the valuation was $197. Right now, it's about $200. But given that the stock has dropped $50+ over the last few weeks, it could drop another 20 in the next 2, and I could be buying the stock. I actually have a limit buy on the stock at 180. Now, it's entirely possible that I've missed my chance that the stock will go back up. But then again, I'm willing to wait. Now, some of you might say, well, if your value is 180, why would you buy the stock at 180? Why did you have a margin of safety? As many of you should know based on my, what I've written about the margin of safety, I'm not a great believer in a margin of safety that's a fixed number, 15, 20, 25%, because beggars can't be choosers. You can have a huge margin of safety. We are surrounded by undervalued companies, and you have a luxury of riches. We don't live in a market. We have dozens and dozens of significantly undervalued companies. I'm willing to buy at fair value. Remember, at fair value, I'm actually getting the 10, 11, 12% return over time. But there's another reason I would buy it at fair value. If you go back and look at the simulation I showed you for Tesla from January of 2023, and you look at the tails and the distribution, this is a stock with significantly more upside than downside. In other words, intuitive with Tesla, it's always what other businesses can Tesla get into? That's an optionality, which effectively means that at fair value, you're getting these other options that you haven't valued for free. And I'm going to take those options. I also believe that this is not something I would thrust on you. I'm not trying to convince you to buy Tesla, sell Tesla. That's your choice to make. In fact, if you take the spreadsheet that I've put together for my Tesla valuation, you're welcome to play with it, change it, modify it. In fact, rather than take my story and complain about what you don't like about my story, make it yours. Change the parts of the story you don't agree with. Come up with your own judgments on value. And then, then make your own decision on whether to buy or sell Tesla. But, for the moment, I am sitting and waiting and hoping that I have Tesla in my portfolio by the end of the month or the end of next month. It might not happen, but I'm sure I'll get a chance to revisit this company again. How can I avoid it? Thank you very much for listening, and I hope you've enjoyed this session.